Welcome to the Pirls Stock Market Commentary video, your weekly window on stock market technical conditions, featuring the proprietary bull-bear point and figure market breadth summary chart for December 17th, 2017. Market breadth. With this past week's market fractional advance, our bull-bear point and figure ratio at 1.32 was virtually unchanged from 1.34 last week, remaining within bullish territory. The total count of securities in bullish or bearish patterns increased 1% to 3,114. The count of bearish stocks increased 2%, while the count of stocks in bullish patterns increased fractionally. The Pirls PNF Market Breadth Summary Chart shows us a market now 16 weeks in bullish territory. Paid subscribers have access to the OpenOffice Calc data from which the chart is generated. You may become a paid subscriber by visiting s2pmarketsignal.com, clicking Membership, clicking Register, and following the prompts. To receive the Pirls Stock Market Commentary via email on a weekly basis, free of charge, simply enter your name and your email address in the spaces provided and click Subscribe. The well-known market breadth indicator, the Nasdaq McClellan Summation Index, fell 49 points for the seventh decline in 9 weeks. At a positive 88.21 points, it continues below all 7 tops in the last 30 months and continues above all 5 bottoms in the last 30 months. Volume analysis. In this week's volume analysis, the Nasdaq Composite Index ended in accumulation mode, with average daily volume higher than the prior week. In the last 2 weeks, the Nasdaq had 3 accumulation days and 3 distribution days. Accumulation days are counted when the index closes up on higher volume than the prior market day, while distribution days occur when the index closes down on volume higher than the prior market day. Last week, the Nasdaq ended in neither accumulation nor distribution mode on lower average daily volume. Momentum. The CCI 20 daily, in a Woody's uptrend, is now at a positive 136.85, up from a positive 53.4 last week. At Wednesday 12/6 close, the CCI 20 daily was within the plus or minus 50 range for a zero-line reject pivot and long entry signal at Thursday 12/7 open. We will continue to follow this trade simulation in next week's commentary. Our trade exit occurs when the CCI 20 close drops below plus 100. In Woody's CCI trading system, 6 consecutive bars above or below 0 are required for a change of trend. The weekly CCI 20 of the Nasdaq Composite Index began a Woody's uptrend 85 weeks ago, while the daily CCI 20 began a Woody's uptrend 14 weeks ago. The CCI 20 weekly at a positive 123.87, up from a positive 108.27 last week after forming a zero-line reject long entry signal for Tuesday 9/5 open. Our rule is to stay in the trade until the CCI 20 drops below plus 100. We will continue to follow the result of this trade simulation in next week's commentary. Industry rotation the last 2 weeks. All of the top 5 industries are positive, and all of the bottom 5 are negative. Summary: some tech and gold and silver on top. Oil services on the bottom. Bullish: comp tech, disk drives, computer hardware, and semis have entered the top 5, with all except computer hardware leaving the bottom 5. Oil services has left the top 5 and entered the bottom 5. Bearish: KBW Bank and brokers have left the top 5. Gold and silver has left the bottom 5 and entered the top 5. Focus this week from www.ffwiley.com/blog. Never mind tea leaves, here's a strong signal from the economic dashboard by Daniel Nevins. The following are some key points and a chart. Most forecasters expect the economy to expand through next year, believing that the Fed and the yield curve aren't yet restrictive enough to trigger a recession. The idea is that the economy tends to turn over when investors lose money, borrowers find it hard to obtain financing, business earnings weaken, and banks struggle with a flat or inverted yield curve. Asset gains have been stellar over the past 4 quarters, far above the flat or declining performance that nearly always precedes business cycle peaks. Of all the rules in economics, the rule that asset prices lead the business cycle is as reliable as any, and they're a long way from recessionary as of this writing. In fact, if Q4's gains match the average gains over the past 4 quarters, real asset gains for 2017 will reach 25% of personal income. That's 3 months of personal income from asset gains alone. Hardly an environment where households stop spending and the economy slips into recession. But eventually, monetary tightening will have greater effects, and the outsized asset gains of recent years will become more burden than boon. We'll just couple our bullish economic view for H1 2008 with a chart we first shared last week. Although the chart includes only 7 business cycles to keep it readable, the full history shows asset gains adjusted for inflation jumping above those of any other cycle since the Fed began recording gains in 1947. It paints a bigger picture behind the virtuous loop that's currently fueling the economy and thus far impervious to the Fed's snail-pace tightening. Thank you for watching this week's Pirls Stock Market Commentary video featuring the proprietary bull-bear point and figure market breadth summary chart compiled by Donald Pearl, www.s2pmarketsignal.com. Hoping that you are enjoying a peaceful and pleasant weekend, that you are looking forward to a prosperous and productive week coming up, and wishing you true success.